Hi, I'm Joe Aston. I'm the Sales and Commercial Director at Aria Finance, and I'm joined today by my colleague and a team leader within our business of our second charge division, Adam Laws. Hi, Adam.
Hi, Joe.
So we're going to talk a little bit around the second charge market. It's a market that was north of 20% up year on year from a total lending perspective, and it's still an untapped opportunity for many brokers in the market and in the space where their borrowers may be asking for more money out of their property, but it's inappropriate or the wrong move, or they're unable to take more money out from a first charge basis, and there are other options in the background. So I'm keen to discuss with a legitimate
Yeah,
expert in the market sort of how that looks, what opportunities there are. And you've been with us a long time as well. Talk to us a little bit about your experience with our business.
sure. Okay, so just giving you a bit of historical context. Joined the company when we were formerly Enterprise back in 2017.
Yeah.
So coming up to a decade in the industry. Prior to that, I was more so specialising in first charge mortgages.
Hmm.
So sort of seeing things both sides of the fence here, and yeah, grown as the company's grown, learned more, taken on more. So keen to share and impart some knowledge today.
Yeah, good. And it's funny because actually the product has evolved so much in that time. You've probably grown with the product, but how different does it feel as someone who, as much as you're in a team leader role,
Yeah.
you're also running your own pipeline and one of our senior advisors in that business? How does it feel running second charge mortgages now compared to back in 2017 when you started?
So yeah, the landscape has completely changed. It was back in the 2016, you saw the Mortgage Credit Directive come in place where
Mhm.
these products become regulated products, and adhere to the same stresses and same disciplines as your conventional mortgage products. The process in which has evolved over the last 10 years is very compliant, more efficient. We're seeing this from our lenders as well in their standpoint, in the way that they assess cases, the way that cases are keyed into their systems as well,
Mm.
their decision choices. So the whole process has evolved. It's become more compliant, more strict, more mainstream, and more conformed.
Mm. And it's funny because the market now is massive, over £2 billion worth of second charge lending last year. And actually, within what is still a tight knit lending sort of environment, in terms of lending options, there have been a couple of new disruptors in the space in the last 2 years who have taken big market share and are growing as well. How have lenders and their processes changed? Is this a complicated loan? Is it efficient? How are you finding actually the delivery of these facilities
I
now?
certainly think in certainly the last 2 years, the process in itself has evolved to such a degree where things are more efficient, more streamlined. Yes, there's still the manual decision making, which is the fantastic element of the second charge mortgage, and that runs to a certain degree completely different to your residential mortgages, where it might be the case the computer says no. On
Mm.
the second charge, there is that manual input, there's that human decision making being placed. However, on the operating system front, these systems are more efficient. You're seeing the increased use of automated valuations, so taking that out of the mix as well, with as opposed to a physical valuation, is further speeding up the process. Our lenders' portals are more efficient in making quick decision making initially as well. A lot of our lenders also dynamically price their products as well, so
Mm.
they can adapt to the marketplace and really capture business where they feel there might be a particular need to capture this business in specific product ranges.
Mm.
But it allows them to react to external market impacts as well.
Yeah, and I think that's a really key point because, you know, I do a lot of, as you know, I write unregulated business. I do commercial and bridging finance and buy to lets. But one of the big selling points for our industry and our sector and our business is that we live and operate in the grey, and regulated arm of mortgage lending has always been a little bit more rigid. But second charge is a bit of a hybrid, like you say, that there's a human being at the other end. You can have a conversation, and if there's a common sense approach to be taken, there are lenders that will go down that path, right?
Correct.
Yeah, which is great. And you touched on something really interesting there, which is efficiency and speed, which again is a major reason and motivation for some borrowers to look to this product where actually it's just an immediate requirement and the equity they have happens to sit within the residential home, right? We're turning deals around, I think on average it's something like 10 working days from application to completion. But how quickly can a second charge be done?
If everything aligns and in the perfect storm, it can happen within the same day. We've had cases complete within 5-6 hours. Now, I'm not saying that is going to be
Yeah.
the norm, but most certainly the efficiencies and the process is there with our lenders that we have to allow that to occur.
Yeah, it's the right caveat to say I think those are the unicorn cases, but the fact it can be done is great and highlights with a motivated borrower and the perfect storm of
Yeah.
circumstance it can happen, right? Inevitably, there'll be a wave of inquiries now looking for 5-hour turnarounds, so hopefully not. Um, just if we take a step back, look, there are still a lot of certainly borrowers and consumers, but also a lot of brokers in the market, competent, experienced, and expert mortgage brokers in their own right, who maybe don't fully understand or are aware of what is a second charge mortgage. Can you give a high-level summary of what is a second charge mortgage?
Okay. Yeah. So the name suggests exactly as to what the product is. It is a second charge against the home. It is a secondary mortgage payment that is made in conjunction with your first payment each and every month. Now, the need for that product might arise for multiple reasons. The most widely recognized reasons as to why somebody may wish to take out a second charge mortgage very likely is either they're adversely impacted. So they've gone to their mortgage broker, they've gone either for a further advance or further borrowing on their current mortgage facility, they've looked at a potential remortgage, so taking their existing mortgage and going with a new provider and potentially looking at additional borrowing there. And it could be to what we alluded to earlier, very simply where it is the computer says no. The second charge comes into fray where the clients want to try and maximize their borrowing capacity. Their credit score, very simply, doesn't enable them to do that with high street lenders. So again, it could be that you have a client that is keeping all their items of credit up to date each and every month. But very simply, their credit utilization has an impact on their credit score. They're not a bad borrower by any means. It's just very simply they're not able to borrow through their high street lender because of the scoring algorithms in place with those lenders.
Yeah.
So that would prompt another reason as to why somebody might look at a second charge mortgage. You have the typical don't want to currently disturb a historic rate of interest, or they might find themselves on a very preferential rate. You know, those rates or clients that were locked into fixed rates prior to certainly 2022, it's not uncommon to still see and have discussions with clients that are sitting on interest rates between 1% and 3% in some cases. So they may not want to.
And that's an interesting point because I think, you know, if I go back in time 5 years, we would see loans come in for, if I'm with a broad brushstroke, one of three reasons, right? Avoiding paying the ERC, stretching their income further, because income multipliers start at 6 times income, don't they?
Yeah.
So you can factually raise more on a second charge. Or they were consolidating debt. But that protecting a legacy rate is a landscape shift and is a new trend in the last couple of years. And you're quite right. At the time of us filming this, you know, you've got borrowers on those 5-year fixed and they are 3 years in to those rates still sub 3%. So the ERC becomes less the driver in taking second charge debt. It's protecting the original rate, right?
Yeah, exactly that.
Yeah. There's been a new trend as well of sort of newer rationale, newer reasons for people taking second charge borrowing. And some of that, and I'm keen to know some of the more nuances around these from your side, but one that I see in the market is there's a wave of borrowers taking PTs execution only, particularly in that year 23 that was really difficult when the first charge lenders, I think, were really proactive in reaching out. There were quite a lot of execution only, product transfers, someone panicking, getting it done early for peace of mind, then realizing they wanted to tap into debt. We can raise a second charge pretty much at day one behind a PT, right?
Correct.
Fantastic. And the second thing then is that in a tighter economy with the cost of living crisis still bubbling away in the background, we see a lot of people who've gone from a lifetime of PAYE employed to self-employed, or people who were clean borrowers for many, many years who now have some credit blips, some defaults, something that's not aggressive, but is a credit discrepancy. Actually, those borrowers are more likely to get preferential eyes on them from the second charge market, quicker to lend to self-employed, a little bit more lenient with some credit defaults than maybe the first charge market across their entire debt. Is that fair?
Yes, yeah. No, it's very fair and a good comment to make there. You know, and really when you look at it with a lot of homeowners, you know, a lot of households will carry debt. Some of that debt may be legacy debt. Some of it might have occurred in the last 5 years, you know, as a result of COVID, a lot of earnings. And we still are seeing those inquiries come to us where clients are very simply skiing uphill with their debt, unfortunately.
Yeah.
It's accumulated historically 5 years ago. The payments they're making are very simply just servicing the interest. You're just taking the ice off the tip there, tip of the
Mm,
iceberg. And it's really trying to see how we can help and accommodate those clients
mm,
in moving forward, getting them out of a debt cycle and really getting them debt free, saving them money each month.
yeah.
To put into context and just give you a very brief example here. If you had a couple who had accumulated 50,000 worth of debt, most high street lenders and credit card providers, I'd expect a payment of around 2.5% on that a month. Now, that could accumulate to around just over £700 a month, give or take.
Mm,
If you're condensing that into a second charge mortgage payment, and let's go for a default term of 25 years here,
mm,
at an interest rate, again, a default rate here of 7%, that client would stand to save between £500 and £600 a month at least on the
mm,
back of that. So it is a significant saving here, and
mm.
it's a particular loan purpose which the second charge mortgage market is probably most widely accommodated for and used for.
Yeah, and it's a good point because actually we sort of touched on why, when do people take second charges, stretching income, avoiding ERCs, protecting a rate, those type of things. But the what are they using the money for is a separate conversation entirely.
Yeah.
And sometimes that's what rules out the first charge lender from lending. But debt consolidation is a great example. It's 60% of the second charge lending market. And, that's a huge, huge reason, and not only that, it's because it's a regulated product, right? And correct me if I'm wrong, but actually, a good reputable mortgage advisor doing the right job and the right due diligence is advising somebody here on something that puts them, a product that puts them into a better financial position long term. So although the second charge debt can be a slightly increased rate from the first charge debt, that's a red herring, right?
Yeah.
Because we're looking at the bigger picture and the blended rate and the impact on someone's finances as a whole.
Yes, yeah, and certainly we would go into this in quite a degree when we're talking to our clients. We're assessing what are they currently paying, what does
Hmm.
that interest rate look like, how does it impact to moving forward with the introduction of a second charge mortgage? Very likely an interest rate reduction in most cases, and
Hmm.
certainly in comparison to a standard credit card APR to a second charge mortgage rate, there's going to be a significant reduction there. So we're not only looking at it in terms of an initial reduction in terms of interest rate, monthly cost, how does it impact our client and our consumer
Mm,
longer term as well?
yeah.
And that's something that we look at, not just the short term impact, but also the long term impact to the clients.
Yeah, it's good. And it's a great, it's just a fantastic product and a weapon in our armory to help put consumers into a better position, right? Which, in line of consumer duty, is something all brokers, I think, should be thinking of for their borrowers, certainly when someone's in a maybe distressed position. And I'll add one more thing onto debt consolidation before we move on, but I think one of the myths and misconceptions is that a debt consolidation product, particularly in the second charge space, has to be a rescue product. But we see people taking this proactively, right, to
Yeah.
get ahead of problems that they can see coming.
Exactly that, exactly that. And sort of touched on that point a little bit earlier. With most people servicing their debt at the moment, their payments are very simply servicing the interest.
Mm,
They're not really reducing off the capital and it's just accumulating over time. So
mm.
by proactively looking at these products, they are making waves in taking these credit cards out of the equation,
Yeah, yeah, yeah.
condensing it into one monthly payment, making a significant saving each and every month with the aspiration to hopefully take that second charge mortgage within a period of 1 to 5 years,
Mm,
replacing it back into their primary mortgage.
mm,
And that's something that we also look at and we encourage our brokers that refer to us to also have that eye on as well. We are here to provide that service and not a temporary relief, but a solution
mm.
equally for our brokers and those that introduce to us and may want to introduce to us in the future as
Yeah.
well, the option of, right, we've placed a facility in place for them in the next 1 to 5 years. Is it possible and is it viable that the client can remortgage and exit out the second charge mortgage? The, i- the, i- the ideal scenario is they don't keep the second charge mortgage for the full intended term, whether
Yeah.
that's 25, 30 years, because yes, when you look at the cumulative cost, then they will be paying potentially more long term.
Mm.
But equally, we're looking to plan for both. So we're looking for a efficient short-term solution, explain to the clients the long-term cost implications where applicable, but equally try and give them that mid-term solution and give them back to the broker to really refinance them and exit out of
Yeah.
that product.
It's a great product, and it's, we encourage everybody that actually is dealing with clients looking at remortgaging, looking to tap into equity in the home, looking to consolidate some debts, to consider this and to run it past a reputable broker to understand and ascertain whether it's the right move, right? But outside of debt consolidation, what else are people taking second charge monies for? What's the purposes of some of these funds?
So, I mean, the most widely recognised is debt consolidation. Second to that is more so home improvement.
Yeah.
A lot of people in the current marketplace, they're looking at cost of moving versus the cost of extensions. And sometimes when they've done their due diligence and they've done their cost comparisons, for a lot of people, it might be a cheaper, a quicker, and more affordable solution to consider extending the home.
Yeah.
So we are seeing an increase in clients looking at that. You do have other niches. It might be aspirational purchases, whether they want to purchase a buy to let. You might find, the bank of mum and dad.
Yeah.
So where, you have those that are aspirational. So you have clients wanting to purchase properties, get on the ladder, unfortunately they don't have the deposit there. Mum and dad might look at seeing raising against the main residence. Is it possible to really provide them with that deposit?
Yeah.
To start.
It's a great point, because also the Bank of Mum and Dad is one of the biggest lenders in the UK still, right? Technically, a lot of it's gifted, but the sentiment remains. But, the market has changed, that people aren't as liquid. So actually, to tap into that money to give it in the first place, they're often taking it from their own home or from some assets or consolidating things that they have. So that's a great example as well. One reason that we see quite a lot of, don't we, is, and it comes to us for a second charge because the first charge markets still don't like this rationale, but taking money out of your home to put into your business.
Yeah.
And that's something we can do that's widely accepted within the second charge space, isn't it?
Yes, yeah. There is going to be the sense check in that, to the fact of where, what is the money being used to in conjunction with the business? If it's to grow the business, if it's an established business, is it to purchase additional equipment? Is it to hire extra resource? All these things, and I'll say in a blanket term, typically are subject to referral, to lenders, but most certainly lenders in the second charge mortgage market space have that appetite to lend for that loan purpose. But as anything, some questions may be asked there just to obtain further information, which is pretty typical.
Yeah, I think, look, if those funds aren't saving a business where we think it's going to slip again, actually there's a broad brushstroke, but there's ability to look at that market, which is great because the first charge market isn't there.
Yes.
So, for brokers representing clients who are business owners as well, it's a really good thing to consider. And for me, I've seen a real trend, and a lot of my conversations in the market center on how can we be creative? And I hop back to two things really. And one can be as unusual as it's going back a couple of years now, but we funded a round the world trip, right? But actually the concept of taking money out of the home to send somebody away from the security for 9 months, trusting that their passive income is going to remain, is for glorified cash flow for a holiday, something that the first charge market just wouldn't be allowing. But we had a couple of options in the second charge space. So for the right borrower and the right creative reason, we can step in, can't we?
Yes. And, those funds could be also used for weddings, these once in a lifetime experiences and events, that perhaps the first charge mortgage market space may not be comfortable in lending to. Our lenders would also have an appetite and reason to consider lending for those purposes.
Yeah. It's a great example. And the other one that I really wanted to touch on is the change in private school fees.
Yes.
So we see a lot of this. And actually, as I've done the rounds in the market, we've done a few loans for brokers that we've presented to, talking about their clients, where, adults with children in the independent school structure, their costs have gone up because of the VAT changes. So there's an extra 20% to spend on there. Generally, costs rise year on year anyway. And you can have a saving by paying bulk upfront for a number of years or for the year ahead. And we're seeing a lot of people tap into the home to raise those funds, right?
Yes.
But that, again, from the first charge market perspective, is kind of a cash flow thing. And it's not necessarily widely accepted within the first charge market, but we're really comfortable with that scenario, aren't we?
I totally agree.
Yeah.
Yeah.
Yeah. One to remember, and I think it's a good market. So I guess sort of to finish off really with a snapshot and an intro to second charges, what do you think is going to happen with the space? What are the opportunities that you see coming? And I guess, not to bombard you with questions, but in a nutshell, if you had to give advice to brokers looking to find more second charge opportunity, engage with their borrowers, what should they be looking for, and what can they do to generate more of this business?
Okay. So answering the first part of that question, where do I see the market going? I only think it's only going to become more competitive as the year flies by. Not only are we seeing lenders being more reactive with their pricing, as I mentioned earlier, a lot of lenders are now switching to their dynamic prices and products, so allowing them to really sort of adjust the ebbs and flows of the external market influences very quickly. So we can see price reductions at a whim. It really can be the case of 1 week to another. A very quick rate reduction there. To give sort of context and broadly speaking, in terms of rates, I'd expect really for the low loan to value deals at the moment, interest rates are likely to sit and start around the 5.5%.
Which is competitive, right? I mean, the gap between the first and second charge market is just not that big anymore.
No, it's closing,
Yeah.
month by month. It really is.
Yeah.
And I can only see that going down as the year progresses, and becoming more and more closer and more aligned to perhaps historic market conditions, those that might have echoed a sentiment of 5 years ago, 6 years ago.
Yeah.
And that is really, really good for the market space. Lower rates, cheaper monthly payments, better savings, bigger savings for
Yeah.
clients.
So a growth year again, you think?
I certainly think so.
So to sort of wrap up, what advice would you have then for these brokers that we deal with across the country who are looking to tap into the second charge market and start these conversations with their borrowers?
Yeah. First of all, very, very good question again. So the first thing I would say is any no's you've had on your desk. So, if you've looked at any recent remortgages, any recent product transfers, further advances, a no for you may certainly be a yes for us.
Yeah,
So
absolutely.
that's probably the first place to start looking. For those brokers that certainly find themselves fortunate to have a back book of clients, it really is exploring the opportunities. Those clients have purchased, certainly or remortgaged in the last 5 years. So those that are holding on to those preferential, good historic rates, they don't still want to disturb them. Somebody 5 years ago might find themselves 3 years into their fixed rate. Can they look to borrow those additional funds, certainly at a cheaper cost than what it would be, as opposed to redeeming their current mortgage?
Yeah.
And place everything on a higher rate of interest. So
Yeah.
that might be, certainly another.
It's a ready-made client pool, right? We deal with experienced, competent, expert residential mortgage brokers across the country who are sat on a black book of great borrowers, hopefully with appreciating assets that might want to tap into those funds. So if those conversations are something that a broker has time to do, we'd encourage them to do it, right? And see if there's some opportunity there to support and to help. And finally, for a lot of brokers, whether they're part of a network or they're DA themselves, a lot of them are worried about the advice process, but we're happy to own the regulatory responsibility, right?
Exactly that, and in in most cases, we'd recommend you do that, really let us do the heavy lifting. It can be very simply, give us the name, number, a very brief backbone, backstory to the case. We'll take it off your hands. It's our job. It's our bread and butter. Alleviate the stress and the workload. You concentrate on what you are the expert at, and let us do what we're best at.
Yeah, quite right. Well, look, I'm really grateful for you taking some time out to come and do this as a true expert as well. Thank you to everyone that's either watched via our emails or online. Really appreciate it. If you have any questions about getting into the second charge market, any second charge cases or borrowers that you think could do with a conversation, do get in touch with our team and we'll try and help.